The Strategic Yield Fund is a fixed income product comprised of corporate debt from borrowers that are mainly in the US. The fund is currency hedged to reduce the US dollar currency risk. The idea of the fund is to generate return on capital in the form of interest payments by acting as a lender to various corporations in North America. When we say acting as a lender, what we mean is that the most important consideration in our team's investment process is the margin of safety afforded through asset value at the companies we lend money to. For example, if we're lending $1 to a company, we would like to see $2 to $3 of asset value and a healthy, stable, or growing business so that we're confident we get our interest payments and our principal back. Strategic Yield is a fund comprised of 50 to 70 bonds from various industries that the team has often been researching for years. The internal yield, that is, the yield of all the bonds in the portfolio added together, is normally in the 6% to 8% range, so that in the history of the fund, we've been able to generate a mid to high single-digit return to investors. We think that if interest rates are going up, then our current strategy will do well, especially compared to more traditional fixed income funds. Rising rates generally mean that the overall economy is growing and economic health is improving. If interest rates are going down, then we will adapt our game plan accordingly and favor bonds that increase in price with lower rates. The great thing about our strategy is that we operate mainly in the US, where there are thousands of companies that we can potentially lend money to. We take the universe of potential borrowers and screen for a number of attributes, including industry attractiveness, high level margin of safety, trading liquidity of the bonds, and relative value. One of the most fundamental tenets we apply, having learned through more than 25 years in the business, is that we want to stay away from industries that are in secular decline. For example, we have not been lending money to companies in the wireline phone business, newsprint producers, or radio stations, even though there are many bonds we can buy in these sectors. More recently, we've been avoiding companies in the storefront and shopping mall retail sector as consumers transition to buying goods and services through the internet and through apps. Once we have screened our initial universe, we do a deeper dive into potential borrowers and evaluate factors including their management, operating momentum, and industry positioning. We generally meet with the management teams of companies in which we have significant investments. In many instances, we've been through a number of lending cycles with the same companies and management teams, where the borrowers have paid us back and we will subsequently lend to them again. Our strategy can only be described as active management. In the corporate debt world, there are a number of passive products, or ETFs, that have gained a lot of popularity recently. The problem with many corporate ETFs is that they decide which companies to lend money to based on how much money those companies have borrowed already. In other words, a company with more debt outstanding will be more attractive to an ETF. To us, this makes no sense at all. Why would you want to lend more money to a company just because they've already borrowed a lot of money? That's why we actively screen for margin of safety and other fundamental factors. And that's why active management makes the most sense in the corporate debt market.